Regulators have had stablecoins on their radar for quite some time now, and we may now be on the verge of witnessing the bullets fly as U.S. regulators have finally released their report concerning their review on stablecoins, containing the regulatory recommendations that might make or break the current $130 billion worth of stablecoin industry. Early in September, officials in the United States were considering opening a formal investigation into whether Tether and other stablecoins pose a risk to financial stability, a move that might result in significantly more monitoring for a fast-growing segment of the crypto market. This could be a total game-changer for stablecoins, as they are critical to the crypto market because traders use them to acquire Bitcoin and other virtual currencies. Stablecoins have thrived in the shadows, with tokens valued more than $120 billion in circulation, according to CoinMarketCap.com. They're also increasingly being used for transactions that resemble traditional financial products, such as bank savings accounts, but don't come with nearly as many consumer protections. Stablecoins are distinguished by the fact that they are tethered to fiat currencies, making them immune to the huge price volatility that have afflicted Bitcoin. Tether and other companies accomplish this by securing their tokens with assets, such as US dollars and corporate debt. And now, finally, after weeks of careful consideration, the most awaited report from the President's Working Group on Financial Markets, the Federal Deposit Insurance Corporation, and the Office of the Comptroller of the Currency on Stablecoins has finally been released. So, what does it hold? What risks are stablecoins currently facing after the release of this report? What are the concerns regarding the stability of so-called stablecoins? What recommendations were given? And what future does it hold for Facebook, who has long expressed its intentions to break into the crypto market? Watch the video to find out about stablecoin crackdown and what it might mean for you and the crypto market. But before that, make sure to hit the subscribe button and smash that notification bell first for more updates. Federal authorities have taken the first steps toward regulating stablecoins, highlighting concerns that the tokens could pose a threat to the U.S. economy, while placing a large bet on the fiercely divided Congress to impose regulations on the rapidly expanding sector. The Treasury Department, Federal Reserve, and other regulators urged Congress to allow them to oversee stablecoin issuers like banks with stringent capital requirements and constant supervision in a much-anticipated report. However, as a backup plan, the watchdogs stated that they would employ a seldom-used power to investigate whether the coins pose a systemic risk to financial stability, a probe that may result in a slew of additional regulations. The President's Working Group on Financial Markets produced a 26-page statement on Monday that marks a turning point for the $130 billion stablecoin industry and the trillions of dollars in cryptocurrencies it underlies. The sector has functioned with little government oversight in the past, and the President's Working Group is delivering a clear message: that era is over. But first, what is the PWG, and who are the people responsible for the report release? The President's Working Group on Financial Markets is composed of the following people: Treasury Secretary Janet Yellen, Federal Reserve Chairman Jerome Powell, Securities and Exchange Commissioner Chairman Gary Gensler, and Commodity Futures Trading Commissioner Chairman Rawson Bennett. The PWG mission is to prevent stock market crashes, which is why they're known as the Plunge Protection Team. The regulators stated the rapid expansion of stablecoins underscores the necessity of this task. Failure to act could result in the proliferation of payment stablecoins without proper security for users, the financial system, and the wider economy. The coins are referred to as stable since their value is linked to another asset, such as the US dollar. Issuers of stablecoins claim to do this by retaining reserves equal to the number of tokens in circulation, and they often guarantee that investors can exchange their tokens for real money at any time. Regulators, on the other hand, have long been concerned that this promise could be broken, especially in a crisis. Though some stablecoin issuers believe that the coins will be extensively used for payments and remittances, most investors use the coins as a safe haven for funds they intend to invest in Bitcoin and other cryptocurrencies, or as a way to transfer funds between crypto trading platforms. According to CoinMarketCap, Tether is the most valuable stablecoin, with a market cap of more than $70 billion. While the suggestions foresee stablecoins as a regulated banking product, the paper underlines that in the interim, the Securities and Exchange Commission, the Commodity Futures Trading Commission, and other organizations can oversee trading, lending, and borrowing operations. The regulators also state that they will not support stablecoins if they are backed by a major technological company or another corporate giant. The paper proposes a barrier between tokens and non-financial enterprises, similar to the long-standing separation of banking and trade. Such a concept could jeopardize Meta's and its partners' efforts to develop a stablecoin called Diem or provide clients with crypto wallet services. Released early last week, here are a few highlights from the report and what it might mean for you. Primary concerns. Despite the fact that stablecoins are now a little component of the global financial system, the research demonstrates that U.S. regulators are well aware of how quickly that might change. The research raises concern that stablecoin issuers may fail to secure their reserves, or that reserves may lose value, making it difficult or impossible for users to swap tokens for real money. According to the research, a lack of confidence in a stablecoin might lead to a run on the issuer, causing the corporation to offload assets in a fire sale and risk not being able to meet redemptions. This might cause a run on other stablecoins, as well as a financial system shock. Payments utilizing the stablecoin may not process or settle as expected, according to the regulators, and if some stablecoin issuers continue to develop rapidly, they may constitute a systemic risk and wield too much market influence. Recommendations to the legislature. The research recommends that Congress approve legislation requiring stablecoin issuers to become banks with guaranteed deposits, capital and liquidity requirements, and Fed oversight. In reality, unless they are insured depository institutions, organizations should not be allowed to offer payment stablecoins. Because stablecoins are an emergent and fast-expanding type of financial instrument, any action Congress takes should provide federal agencies flexibility to respond to how the market evolves. Treasury officials claim they've already had early discussions about crypto supervision with Capitol Hill aides. Given that Democrats and Republicans have failed to agree on much in recent years, it's unlikely that Congress will achieve much. Furthermore, lawmakers have a poor track record of adopting laws until a crisis compels them to, as was the case when derivatives were finally regulated during the 2008 financial crisis. Existing authorities in the areas of market integrity, investor protection, and illicit finance would be supplemented by such legislation, which would address the following important concerns. Legislation requiring stablecoin issuers to be insured depository institutions should be enacted to mitigate hazards to stablecoin users and prevent stablecoin runs. To address concerns about payment system risk, legislation should compel custodial wallet providers to be subject to adequate federal oversight, in addition to the requirements for stablecoin issuers. Legislation should force stablecoin issuers to follow activity limitations that prohibit connection with commercial enterprises to address additional concerns about systemic risk and economic power concentration. Supervisors should have the authority to create guidelines that support stablecoin interoperability. In the short term, the authorities are committed to addressing concerns that fall within their authority, including steps to guarantee that stablecoins and related activities conform with existing legal duties, as well as continuous coordination and engagement on issues of common interest. While immediate congressional action is required to address the risks associated with payment stablecoins, the agencies propose that the Financial Stability Oversight Council investigate the options open to it to resolve the vulnerabilities identified in this study. Existing authorities. The government is relying largely on the Securities and Exchange Commission, SEC, and the Commodity Futures Trading Commission, CFTC, to regulate stablecoins, emphasizing that tokens might be securities, commodities, or derivatives, depending on their form. According to the document, if stablecoins are securities, the SEC has authority over sales and advertising, as well as scenarios in which corporations invest in the assets.